Well, good afternoon, good morning, expats. My name is Jeremy Harper. Thank you for tuning in for another episode of Expat Mortgages. My co-host is back in the seat. James, good morning. How are we going?
Good morning, Jeremy. I'm doing well. It's a lovely and beautiful day today, a Thursday morning on the Gold Coast before we absolutely get swamped by a massive rain deluge. 300 millimeters being dumped in the next 2 days, so can't wait for that one. But mate, it's another day. There's more information, news being fed to us about all different things and policies. I feel like we're on a freight train from hell heading into this budget in May, and we're going to be a little bit spooked and surprised by all these policy changes that might come about, meant to be revenue raising. So we'll be touching on that a little bit very shortly in
Yep.
today's episode. But first off, mate, I wanted to pick your brain about APRA
Yep.
and a couple of things that have come through now that we've seen interest rates go up. And I think this plays into everyone's ability to purchase. But I want to pick your brain about this APRA 3% buffer. Is it here to stay? Like, what is it? Can you give us a bit of a rundown of, understanding how this operates when it comes to getting a mortgage?
Yeah, so obviously APRA govern the banks and they have some regulations in place around lending and they put together the framework and they can adjust the framework. So what we always talk about is when someone goes to go and take out a new mortgage or perhaps they want to refinance, get some cash out on their property or any type of financing on the residential side, what will happen is you'll have your actual rate. So at the moment, most people are taking out a variable mortgage. So whatever that rate is, obviously the RBA is increased in February. So that means that, we'll be adding 25 points to that new mortgage rate that you'll be taking out. And APRA will come in and say, okay, that bank, and if it's a ADI or licensed bank, so let's say like a big bank, we're trying to go to NAB and get a mortgage, and they're going to offer us a rate now with the CBA, with the RBA increasing, it might be say 5.8%. Well, APRA said, okay, you need to be able to qualify for that rate with an extra 3% on top. So not
Mm,
5.8%, which is creeping up, 8.8%, which is actually quite a substantial buffer that's in place right now. So you'll find if
yeah.
if the RBA does increase a couple of times this year, that is going to have a big impact on people's ability to borrow and get access to funding this year.
Okay. So, I mean, I can see with the interest rates going up this year, a few times. This is really going to put pressure on first home buyers because it just means it's probably going to be further locking them out of the property market, given that, you're assessed on this extra 3%. Would there be any reason that they would ever drop the 3% at all? Have they ever done that where they've gone from three down or two and a half or two down? Is there any reason that they could do that?
Yep. So I mean, for people that remember during COVID when rates sort of went through the floor and we had all those cheap fixed and variable rates into the market, APRA did
Mm,
step in and they actually increased the buffer up to that 3% to keep that buffer in place, which I think was good. So that meant that there would basically be a floor there of, 5.5% that you'd have to be the minimum assessment rate versus the actual rate. So that protected some borrowers if they were getting access to cheap credit, that we're
mm,
not being assessed at 2%, we're being assessed at 5.5% that we could afford the repayments. What I
yeah.
think is if rates do go up this year, there'll be an incredible amount of pressure from the government on APRA.
Hmm.
And of course, you'll have the banks standing behind government also putting similar pressure on APRA. But I think
Yep.
it'll come from government to say, hey, we're at 3%. This is no longer suitable. Can we
Mm,
revisit that? Can we make it 2.5? Can we make it 2%? Because
yep.
as we we're saying, as rates creep up, it's going to cut up, particularly that first home buyer market, being able to get in. Because if they're trying to qualify at a rate of say 9% buffered, a lot of
Yeah.
those first home buyers won't be able to access that program that came through last year.
That's right, actually. That's a really good point. Because yeah, and I wonder, taking this a step further, and obviously you and I, we're not policymakers, but should they, I wonder if they should really soften the rules around first home buyers, just so, it makes it a little bit easier, because obviously, yep, interest rates, they are going to go up. We'll probably get at least three interest rate increases this year. We've already had the first one. So that means that we're all being assessed on, 8.75% or whatever it might be, depending on the rate. So with that in mind, Should they soften it? Or are the first home buyers the ones that should be protected here because they're most at risk if they're using that 5% home deposit scheme that if interest rates go up, they're really going to probably struggle maybe and they might be in the red when it comes to their mortgage repayments.
I think there needs to be still some safeguards in place for first home buyers because we've talked about this previously, if you were going
Mm.
from renting to taking out, $1 million mortgage to get yourself a two-bedder in Sydney,
Yep.
your repayments are going to double 2.5 times what you're paying in rent. So I think you need to have some sort of safeguards around that because that's going to be a big adjustment for that type of borrower. I think for the established borrower that's perhaps trying to get some equity out, yes, there needs to be some nuance there, particularly on the owner-occupier front, because you want to continue to have that credit flow through that market.
Mm.
Interesting you asked that question. There has been some policy update on the bank side where there's a few products now that have come out where they said, look, if you're in a mortgage and we can show 12 months of repayments on that mortgage and we can get you into this product and reduce your repayment. So let's say perhaps you're with a second or a third tier lender where you're on a higher rate, but you've been able to maintain the mortgage repayments. And we can show that you're going to go into this refinance across
Mm.
and we're going to reduce your repayment. You just need to demonstrate that. So tick off that it's a lower repayment, show them 12 months of the mortgage statements to show a great repayment history, and then they're not actually interested in seeing other income for verification. So if you're, in between self-employed, et cetera, and things get a bit difficult to show the bank, you don't need to provide that. So that's a good little option there. But to your question around investors, I mean, yeah, there's lots they could do. Obviously, APRA's come out and they've put in that sort of DTI cap at 20% of the book on the investor side. That won't really do a
Yeah.
lot.
No.
But you're 100% spot on. The APRA could come out and say, well, let's put a 2% buffer for owner occupier loans, and then for investors we could put it 4%. But of course, there's going to be a lot of pressure from banks around that. Is that fair? A lot of the big banks, they're driven by investor lending to make their profit. So it's something that there'll be a lot of pressure if they try to go down that pathway.
Yeah, absolutely. And I think I want to now drive our focus towards that ASX rate tracker because we're talking about rates, we're talking about the buffer. How's it looking for the rest of the year? How are we heading? Is it going to be going up massively? I think we heard from Matt Common recently after CBA posted its record profit. Once again, I feel like every year CBA
Yeah.
just posts another record profit, to be honest. But they are the most expensive bank around the world in the developed world. But that being said, what's the rate tracker telling us at the moment for the rest of the year?
Well, for the next meeting, which is 17th of March, it's still seen about a 91% chance of a hold.
Yep.
So I think at this stage it looks like the March meeting will be a hold, and then I think really focusing on that May meeting, which is the one after. That's the
Yep.
one you look for. If the data hasn't improved, there may be a movement there, but at this stage it
Yep.
looks like a hold.
I'll see what government spending looks like the way they're going at the moment. All right, man. Well, let's look at another topic here. We're obviously through January. We're moving through the first couple of months of the year. What was the totality home value index look like? What was the sort of property performance from a capital growth based on regions?
Yep. So 0.8% for January, so slight increase on the December month. I mean, I know this is monthly, so it's probably cutting out the data too fine. But
Yep.
December was zero point 0.5, and the same story. You've got Brisbane, Perth, Adelaide, Darwin markets have been moving sort of 1.5, 2% for the mark, so they're rocketing along, and then Sydney and
Yeah.
Melbourne just slightly moving. So
Bit more
Sydney was
subdued.
up 0.2%, and then Melbourne was zero point 0.1. So
Yep.
barely in sort of in line with inflation there.
Yep, absolutely. And I think I was having a look at that report. I know some of the regionals that are close to your Brisbane's, your Perths, your Adelaides and Darwins, they actually moved a bit quicker as well. I
Yeah.
know it's like the Gold Coast did 1% on the January month. So seeing a bit more kick in the regionals compared to the capitals, but that's pretty standard. That's obviously where greater affordability is, but we've also seen those tight rental markets as well. So I wonder what we'll continue to see even as interest rates go up this year. I just think what we're seeing and what the banks are I guess forecasting is still 5 to sort of 7-8% capital
Yep.
growth for the full 2026 calendar year. It's a proven asset class. Interest rates, yep, they'll tack up a little bit. Less investors in the market, but those that can probably invest this year, it's not a bad year at all because a lot of the market will be priced out.
Yep.
Maybe around that sort of 800 to up to probably 2 million. That's where a lot of the market probably will be priced out because that's perfect for those first home buyers based on that 5% deposit scheme that came out, especially in New South Wales. So yeah, low listings, going to still see a bit of rebound behavior from some investors that can afford it. So it's going to be an interesting year, but I think a steady year when it comes to capital growth within the
Yep.
property market. Now that ties in well with this next topic, which obviously is all the rage at the moment. And we talked about on the last episode surrounding CGT, the changes towards the CGT discount. But there's been some updated reports being released by the government.
There has been. Now, we don't want to get too much into detail because it'll probably put everyone to sleep, but there's a report that we've looked into, which has been quoted by, so classic government, they've flowed this through the media. Then there's a bunch of media outlets that are probably supportive of the government have been writing their articles in support. And
Mm.
I think the big number, and you can all have a look at it, it's in the released by Treasury, the tax expenditures and insight statement for the year. And there's a big number there that they've been quoting, which is $19.7 billion is what the CGT discount is costing the government. Big scary number on the high level. But I
Mm.
think, again, I don't want to get into the details because it'll get a bit boring, but there's a couple of things I want to take away from that listeners can go and have a look at themselves. One is the calculation of that 19.7 billion is inclusive of all asset classes. And
Mm.
what has been proposed is removing this discount from just property at this stage. I mean, again, it's
Yeah.
just floated out there to kind of get the temperature check of what everyone's thinking. So obviously 19.7, the majority may be property transactions. I don't know, but within that, there's, small business transactions, there's
Yeah.
sale of
I
shares,
mean,
there's all other assets. So we need to break that down. And the second thing is it's made the assumption now, when you're calculating your tax, it's done at your marginal tax rate. So they're making this, they call it revenue foregone. So it's kind of like a what if analysis. And they're
mm.
saying that, okay, if we were to remove this capital gains discount of 50%, altogether, we would get $20 billion back into our back pocket. But they're making the assumption that taxpayers will not change their behavior. So that you'd still go ahead and sell that property at your same marginal tax rate, which we just know is not going to happen. People would not transact that way. They would
No.
bind to different entities. They would
Yeah.
sell property when their marginal tax rate's lower. You know,
Mm.
that's called tax planning, and
Yeah.
people would be getting 3 or 4 steps ahead of the government on this. So I don't think that property CGT number would be even a fraction of that 19.7.
No, the behavior would definitely change. I think those that are serious property investors would look to invest through different structures. Companies, as an example, companies don't access the CGT discount, but their maximum tax rate is 30%. So you would have very serious investors using companies because they're just capping their tax rate at 30%. There's not really any negative gearing there. On an individual level, everything's just housed within the company. But I guess companies have their merit. You pay the tax at 30%. You can keep the profits in there and then just pay out dividends with an imputation credit. Anyone that's earning an income level of up to 200,000, their average tax rate in Australia is about 30%. So that could become useful for a retirement vehicle if there's a robust property strategy in play there. But I think the government's missed the mark there. Over the last 50 years, anytime there's been a policy change when it comes to tax concessions or tax, behavior changes pretty quickly.
Yep.
So I don't think it's going to achieve anything, to be honest. They're just going to piss off a lot of people, a lot of voters,
Yep.
which is often the common theme. And maybe Labor won't have multiple multiple terms. Maybe they'll just have one.
Yep.
Um, so that's a wait and see, and one to keep an eye on. And I think if we're looking at forward-looking themes this year, I think property will still go up. I think that's going to be consistent. I think totality, I was reading just an article before, said a lot of forecasts are saying about 8.6%. That's their magic number for the year, capital growth wise nationally. KPMG saying that there's still issues around shortages of new housing, even small falls in rates or looser credit can quickly push prices higher again. So I don't think we'll see rates change. I think it'll go up. And then Policy Watch, CGT is the main one there, the CGT discount. Hopefully they don't touch the main residence exemption. But this is going to be an interesting year of changes. Absolutely.
Yeah, it's very, very interesting. It'd be interesting to see what the state governments, because if this changes behavior, if investors are then going to be onto a long hold strategy instead of selling and they're just going to use those assets to pull out equity on a leverage
Mm.
point of view, that's going to
Yep.
have a huge impact on state revenue levels.
Yeah. Yeah,
Huge.
absolutely.
So
Yep.
I'd love to get the thoughts of, the state treasury teams, what they're thinking about these changes, because they know this is how taxpayers will react to this. So it does feel
Yep.
like we're heading into like an election year when it's just really
Yeah.
just a regular budget. This is really,
It does.
yeah, it's a really funny vibe over the next couple of months. And we did say in the previous episode, what happens if, rates do go up and then we have to wait to see what the government does to May, June. So it's going to be a really interesting couple of months coming up.
Yeah. Yeah, absolutely. And I mean, finishing off today with a bit of a question from our Facebook group. So the
Yep.
Australian Expat Financial Forum. If you're not in there, jump in. There's some great things going on of expats helping each other out. But a quick one here for today. Questions come in saying, Jeremy, can you unlock equity in your former main residence back in Australia and take that equity overseas? So might need to unpack that one a little bit. But what's your understanding there?
Yeah, so again, assuming serviceability is there, we've got enough equity in the Australian property, and it sounds like they're maybe trying to buy a place of residence overseas.
I'd say so,
Um,
yeah. There's not much context behind it, but that's probably the most common theme we see when they're trying to do that.
yeah, so it can be done. It really just will depend on the bank's individual credit policy. So some banks will have a bit more restrictions around taking the funds abroad. They're happy
Hmm.
to release funds if it's to buy a property in Australia,
Yep.
whereas some other banks are happier or a lot more comfortable to release that. So yes, it is. It just depends on the individual credit policy of that bank.
Yep, absolutely. And it's an interesting one as well because you're unlocking equity. The PPR is a investment property back in Australia, assuming it's rented out. So there is a bit of a challenge there on how your Australian account would treat unlocking that equity because you're not
Yeah,
technically using it for an investment purpose,
correct.
but you're also not a resident. So I dare say that by pulling out that equity, it's for a non-deductible purpose.
Yeah,
So just bear that in mind. You're creating a mixed use or mixed purpose loan
yeah.
where
So you want to
only a
split that
portion.
out.
That's exactly right. Jeremy would talk you through the loan maintenance and making sure you segregate them appropriately. Otherwise, your accountant will come after you,
Yeah,
especially,
definitely.
especially the accountant. That's a good spot there, guys. Thanks for tuning in on another episode. Some great episodes coming up with plenty of guests that Jeremy's been interviewing, so can't wait to hear those ones. Keep an eye on the socials. Plenty of big events coming up, especially in the US and Southeast Asia, and later in the Middle East as well.
Yes, looking forward to it.
Easy. All right, guys. Thanks for tuning in. See you on the next episode. Thanks,
Thanks,
mate.
James. Thanks, guys.